So welcome everyone to the third in Advivo's series of Business Booster events. Today my fellow Advivo partner Chris Morris and I will be talking and answering questions for you about how you can minimise your business tax. These Business Booster events that we're running are intended to be quite interactive, and so we would encourage you to turn your camera on if it's suitable to do so. We would ask though that if you leave your microphone turned off unless you're actually asking a question, just so that we can minimize the amount of background noise at any one time to perhaps one barking dog or screaming child. Please do feel free to ask questions via the chat box. If you are going to ask a question verbally, can you please just let us know via the chat box first so that we can answer things in a fairly logical order rather than everybody trying to talk at once. We do have quite a number of pre-submitted questions for this event, so we're going to start off by running through some of those questions that Chris and I will answer. And once we have done those, we will work through any that have been submitted via the chat box and have an opportunity to answer those. Hopefully we'll be able to get some good interaction and different questions, and hopefully some of the ones that will be have pre-submitted may provoke some questions that you haven't thought of already. The session today will be recorded, so you can always come back and watch it afterwards. So I might kick off today just with a couple of basic tax planning tenets, and hopefully we'll kick off a bit better than New South Wales last night. So the first thing I would say is don't take tax planning advice from people who are trying to sell things to you. They're looking for a sale. They're not qualified or licensed to advise you on whether something's tax deductible and how.
Yeah, mate, we want to go. Mate.
I'm just going to get Ashgrove.
Yeah.
Stop in the village there.
Ashgrove Central. That's fine.
Sorry, we just got a bit of background there. Someone's not muted. So I guess if someone's trying to sell you something, if you spend $1, you're going to get $1 of tax deduction. You don't get $1 back from the government. So it's important to remember your tax saving is only the percentage of tax rate. So if it's a company, a business trading, it's 25% tax saving. You're 75 cents worth off. If you're a passive income, it's 30%. If you're a high income individual, it's up to a 47% tax saving, but it's not 100%. Other basic tax planning tenets is to remember the time value of money. If you can save $1 today, you're better to do that than to save it tomorrow. You should keep all your records for anything that you're potentially going to claim a tax deduction for. If you don't have a record for it and the tax office come knocking down the track to check what you've claimed, you're going to have a problem. So that's a big problem. So if you're tight on money but you want to look at tax planning options, make sure that you have a few options available to you that I'll run through, but I probably should say you can all say the disclaimer on the screen. Everything today is general information. It's not specific tax advice. What we're covering is very much needs to be tailored particularly to your own circumstances, and what works and maybe a valid tax deduction for one person is not going to be for someone else. So keep that in mind. But coming back to options for a cash-strapped business to look at tax deductions and saving tax, think about things like looking at your debtors. If you've got people that haven't paid you, do you think they're going to? If the answer is no, then look at writing those off as a bad debt and you'll be able to claim that as a tax deduction, barring the GST component that will get reversed on your BAS for that period. Look at deferring invoicing if the impact of doing that is not going to make a big timing issue for your cash flow. So if you invoice on 1st of July rather than 30th of June, does it push back when you're going to get paid by perhaps a day? Or is the impact going to be a month later of payment? Maybe not such a good idea. Conversely, look at your suppliers and ask them to invoice you prior to 30 June if there's work that they've got in progress for you. You'll get that tax deduction this financial year, which will effectively be 12 months ahead of when it would be if it's invoiced in July. The other one to think about, if less so from a cash flow perspective, but if you have employees, you're going to have a superannuation liability for them that's due 28th of July, but there's no reason why you can't pay the super for this quarter before 30th of June. Superannuation is tax deductible based on when it hits the people's super accounts. So as long as you get that paid early enough before 30 June, then that'll count as a tax deduction this year. Just be careful. A lot of the clearing houses for that take quite a bit of time to process. I think Xero have said that you need to have that done by the 18th of June. So just check the detail on that for your software and clearinghouse to make sure that that gets in time. So moving on from general tax planning tenants, the first pre-submitted question we have today was, I'd like to buy a new Mercedes. Can I do it in my business or my company? And can I claim depreciation, GST, and running costs on the car? Well, vehicles are always a fun one. First thing is you need to do a logbook for it to work out what your business use is. If you're looking at buying through a business entity, cars are a depreciable item, and they actually have a depreciation limit on them that's similar to the luxury car limit, and the amount for that is $60,733. So that component of the purchase cost does get depreciated, but because there's the instant asset write-off these days, you basically get that amount as a full upfront claim, so that's great. GST, you can claim GST, but you only get it up to 1/11 of the depreciation limit, so you only get $5,000–6,000 worth of GST claim. So if your new car costs $120,000, there's going to be some of that GST you don't get back. That's some of the good news. The bad news is there's going to be fringe benefits tax on that car, and that's going to be an ongoing issue for you and an ongoing lot of administration to deal with in collaboration with your accountant. You'll need to make some contributions into your business to cover the private use of that car, and those contributions you make will have GST on them that will be a liability to the business as well. So our usual rule of thumb at Abevo with particularly luxury cars like Mercedes and really anything that's above that depreciation limit is, in most people's circumstances, you're actually better off just keeping that out of the business, particularly if it's not got extremely high business use, and put it in your personal name, and then you don't have all the admin headaches. The last caveat on that question is to get the immediate write-off or depreciation claim in a year. For a depreciable asset, it needs to be, the technical term is, installed and ready for use by 30 June. So for a car, that means you need to have the keys by 30th of June. So if you walk into a dealer today, you've pretty much got to deal with whatever they've got on floor stock, or otherwise you're probably not going to get it. So that was an interesting question. I will throw to Chris for the next question. Over to you, Chris.
Thank you, Dale. I actually love that question. Should I buy a car to save tax? I love it. It's always a cracker. The answer is no, not unless you need a car. Don't ever buy a car to save tax. Anyway, okay, the first question that I've got is, can I really prepay expenses to get a tax deduction for them? And if yes, are there any limits on them, on what I can prepay? So like Dale said before, the general premise of strategic tax planning is to bring forward expenses and delay income if possible, legally, obviously. So the short answer to this question, can I prepay expenses? The answer is yes, absolutely. And I'll kick off with the limitations that apply. They're fairly broad. Specifically in this instance, I'm talking about those that apply to small businesses. And the ATO's definition of a small business these days is with turnover of less than 50 million. So I think that probably covers off most people in this room. So it would apply to most people here. The other prerequisite in order to have a prepayment that qualifies is that the benefit of that prepayment must be recognised within the next 12 months. So you can have a prepayment for an expense up to 12 months, but if the benefit exceeds 12 months, then it doesn't qualify as a prepayment and it needs to be pushed out again. So really the main ones that we're talking about here is interest on certain types of loans. If we can get some interest prepaid, it could help to bring forward that expense. Insurance and registrations is worthwhile mentioning because they're prepayments anyway. Insurance though is an interesting one because just be aware, and I realise there's some familiar names and for us on this list, but there's also some people who aren't clients as well, which is good to see. Just be aware of how your accountant is treating those in your books, especially if there's premium funding involved, because sometimes depending how they're treated in the books, if there's premium funding, the way they're recorded could inadvertently push that insurance expense back push it back to future years rather than bringing it forwards, which is what we want to do. The other main prepayment, which is definitely worthwhile mentioning, is rent. Rent is an absolute cracker when it comes to prepayments. And thumbs up, I like that, Craig. Rent's an absolute cracker when it comes to prepayments. There's some really good opportunities, especially when there's super funds involved, self-managed super funds. Again, not going into any kind of specific advice, but you can imagine the benefit that you'll get from bringing forwards a 12 months worth of rent payments in a trading company. And I will just flag though, if you own the building that you're looking to prepay the rent on, just make sure that you understand the ramifications that flow throughout the rest of your structure, without the rest of your group, as to prepaying the rent, because yes, you get it as an expense in this entity, but it's also, if you own the building, it's also income to that entity. So in many instances, it's worthwhile doing, but also in some circumstances, it may not be beneficial. So like Dale said, it's at the start, it's general advice, but a caveat, I suppose, to certainly all the questions that I've looked at is a lot of them are, it depends. So there's, some instances it works really well, others it could be doing yourself a disservice. So just always just have a check and just ask, but that's certainly one of the key ones. I think that's it for that question. I'll throw it back to you. No, thanks, Dale.
Thank you, Chris. So the next question is, can I put more than my $27,500 concessional cap into super? I didn't put the full amount in last year. So so first thing to say about that is superannuation is a financial product and we're not licensed to advise on it. So all I can do is talk to the mechanics of it and not advise around whether you should or shouldn't. So the concessional contributions cap is currently 27,500, and it's an amount that a person can get a concessional contribution on, so a tax deductible contribution for the year. And if you put in more than your concessional contribution caps, then you end up having to not get a tax deduction and have some other fun mechanics dealing with the ATO because of it. So whether you can put in more than your 27,500 depends on another mechanic which was introduced for the 2018-19 year, which is called carry forward unused concessional contributions. And that means that if you haven't used your full cap in a previous year, you get to carry that shortfall forward and you can use it in a later year. It carries forward up to 5 years. You can only use that carry forward unused concessional contributions benefit if your total superannuation balance at 30 June the previous year is less than $500,000. So if you've got more super than $500,000, then you lose access to this. But otherwise, yes, you can carry forward, and yes, you can put in more than your $27,500 as long as you don't go over what you've got left that you haven't used previously. So how do you know what that is? Well, if you can actually look it up on the ATO online services access if you've got access to that, or your tax agent can actually access that for you. There's a report that the ATO have there that says what you've put in previous years and what you've got left that you haven't used. The other thing to check would be to check what's already gone in the current year. And if you need to factor in what is going to go in between now and 30 June from anyone who puts super in for you. So it's easier to control if you're self-employed and you're the only one who puts in super for you. If you've got an arm's length employer somewhere, then they could do something a bit random that could actually throw you over your concessional contributions, even with the carry forward amount if you're using the full amount. So just factor that in and make sure you've got a buffer. If it's something that you do want some advice from, we're not people to talk to. You need to talk to a financial planner. If you are in that circumstance and you don't have one, talk to us and we can send you to the right people who can help with that sort of thing. So I will flip to Chris for the next question.
Thank you, Dale. And Lee, good question on the side there. I'll just run through these pre-submitted ones first, and we'll definitely come back to that. But that's a great question. I love it. I also like this question, which was submitted, which is, can I pay a wage to my spouse to reduce my income tax? And the reason I love it is because it's such a loaded question. The short answer is, the way that's worded, if the question is, can I pay a wage to my spouse to reduce my income tax? The answer to that is always going to be no, because the ATO have very broad anti-avoidance rules. And at the risk of being a stickler, this is what you pay accountants for. At the risk of being a stickler, if the reason for doing something is to reduce tax, it absolutely falls shy of their anti-avoidance rules. So it's just opening yourself up. If, however, the question was, are there situations where I may be able to pay a commercial wage to my spouse for genuine work which she has performed for, or which they have performed for the business? Then the answer to that question is yes, absolutely. And in many cases, if that's the circumstance, then it will normally result in less tax being payable for the family group as a whole. So it can absolutely work in certain circumstances. A couple of things just to clarify where this does work is the individual must be carrying on a business. I think where the person who submitted this, I think they were talking about where they're carrying on a business in their own name. So they've got an ABN and they've got earnings in their own name there, and they wanted to pay their spouse for the commercial work that their spouse is doing for that business. I will flag though, just be aware that any amount that's paid needs to be commercial. So it really does need to be on commercial terms. So you wouldn't be paying a partner $100,000 a year for 2 hours worth of bookkeeping a week. It's just not feasible. Also, for the same question, I will flag a little topic, which is really not so little, but it's a huge topic with the ATO, which is called personal services income. I certainly won't go into that today, but just be aware that there are limitations on deductions that you can claim, especially with payments to associated individuals when it comes to personal services income. So I'll just flag that. But the short answer to that question is yes, under certain circumstances. Thank you. Over to you, Dale.
Thanks, Chris. Yeah, the personal services income is very complicated, but it really comes down to how much scale and size the business has, or is it just income that's coming from one person's exertion? So the next question that we have involves a business that has generated losses for the year. The losses could have been caused by flooding, they could have been caused by COVID shutdowns, and they've had to go and buy a lot of new equipment as well during the year, possibly because of replacing flood damaged equipment. In any case, the business has got a loss for the year, and what are the options for dealing with that loss? So this one depends a fair bit around what the actual structure of the business is. Generally losses, yes, you can benefit from them, although it's normally a future benefit rather than in the year of loss. So the good news is you don't normally lose it, but the bad news is you don't normally get a tax benefit at the time you've had the loss. So to run through the most common business structures, if you're trading under your own name as a sole trader, there's a series of non-commercial loss tests there. And if you can pass those loss tests, you may actually be able to get a tax benefit in that year if you've got some other income in your name than that business. So say if you also have another job as an employee somewhere, you could then, if you pass those tests, claim that loss against your other wage income, or if you have some investment income in your own name. So that's one scenario where you can get a more immediate tax benefit. If you happen to not pass those non-commercial loss tests, you don't lose the loss, but you just need to keep that business activity going. And then when it generates some profits, you can offset those losses against the profits in that profit year and save some tax at that point in time. For a partnership structure, and when I say that, I really mean a couple of individuals running a business together as a partnership. It's really the same as the sole trader arrangement, except you just test it at each individual owner partner level. If your business is operating through a trust, the losses basically get quarantined until a future year when you have income, and then you use them. I would say though, if you've got that circumstance, don't forget to make sure you do still have a trust resolution for the year, because you may have what's technically called trust income, even though you have a tax loss, because you might have equipment that's been written off for tax purposes, but not for trust income purposes. Very complex, but that's what your accountant's there to help with. Companies are the other obvious trading structure, and they're probably the most interesting one at this point in time, because at the moment, for this year, at least, we have what's called a loss carryback, and the loss carryback actually lets the company that has a loss in the current year but had paid tax on and had income in the prior year, it actually lets you claim back some of that tax that you paid last year, depending on what the amounts are for this year's loss and last year's income. So you can actually claw back some of the tax that you paid on last year's, which does provide an actual cash flow benefit at a time that your business is struggling. The other thing to be aware of for companies using that loss carryback, I don't believe you actually have to use that if you don't want to. So it is optional, it's not a required. If you do use it, it does impact the franking account for a company, and the franking account is how much tax credit you have to pay out attached to dividends. So this becomes one of those scenarios where you really need to talk to your accountant if you're looking at using that loss carryback in the year, but also there's been dividends paid, or there might be dividends paid. Need to sit down with the accountant and crunch the numbers of that to see how much franking credit's actually going to be available there to pay out with that dividend. So I will switch over to Chris now for the next.
Thank you, Dale. The next question that came through that I jumped on was, another interesting question due to what's going on at the moment. I've been told that I'm not allowed to make trust distributions to my children, which is something I've always done. What's that about, and should I be worried? So I think what this question is referring to is 3 documents that the ATO have recently issued. And just to clarify, the distributions to children is absolutely still possible. So you can definitely still make distributions to kids. the ATO changed the rules some time ago to cap the limit for kids at $416. Essentially, it's a few mechanisms that work to achieve this, but essentially distributions to kids under the age of 18 is $416. Otherwise, you get into silly rates of tax. What this question is really about is these 3 documents that the ATO have released. One of them is a draft ruling, which specifically refers to how the ATO are now going to be interpreting a specific piece of legislation. Now, that's what's significant about it is they haven't interpreted this piece of legislation that way previously. And what's more, they've also said, oh, we're now considering this, and we're going to consider it back from 1 July 2014. So that's why this is on people's radars. The second piece of, the second document that they've also issued is draft practical compliance guidelines. What that means is they're actually, it's not quite, but it's essentially an internal document for ATO officers, which tells them how they want their internal officers to treat certain situations. So they've gone to the extent of doing that. And then the third one that they've issued, which is fantastic, is a taxpayer alert, which is titled, this is the scary side of things, which is titled Trusts, Parents benefiting from trust entitlements of their children over 18 years of age. So that's really what they're targeting, and that's what's got people talking about this. It is actually worthwhile considering. We've flagged for some time with clients that if you're making trust distributions to adult beneficiaries, be aware that there is a legal entitlement there for that beneficiary, that they're entitled to that cash. And the issue that the ATO have got are arrangements where adult beneficiaries, so adult children we're talking, are receiving trust distributions on paper, but they're never actually getting paid to the kids. And that's what the ATO is really targeting. So the simplest way around it is if you're declaring income to adult children, then just get it paid. If you don't actually want to cash flow that cash, that's fine. Just consider not doing the distribution to the children if that's the instance. So really the great tax benefits for this comes around what we talk about being the golden years of when your kids just turn 18 and they're at the start of their careers. So their taxable income's not necessarily that high in the field that they're in, or they might be studying full-time, part-time work, they might not have any work at all. So you've got somebody there at the adult tax rates, which if you put a trust distribution to them, obviously they'll be paying less tax than if that amount were to go to somebody else who's on a higher tax rate. And that's where all this is coming from. So the question really comes, can you still make a tax-effective trust distribution? Sorry, can you still make tax-effective trust distributions to adult children? And the answer is yes, but just have a think about the circumstances on which you can do it. Like, yes, if you're actually going to pay the cash is the answer to that question. So some arrangements that people should be thinking about is, for example, like if you're paying your uni fees for your kids, it might just come out of your bank and go straight to the uni, you call it done. Consider actually saying, okay, well, let's make this a trust distribution to the kids for the year, and then they can pay the uni fees themselves out of their thing. It's actually cash flow that goes to the accounts of the trust, and that helps determine how much distribution is going to the kids. So things like uni fees, help with home deposits. A lot of parents chip in for cars, birthday cash. I know a lot of people have got a regular investment plan for their kids. And granted, it might be while they're a little bit younger. By the time they're 18, they should be doing that sort of stuff themselves. But I know some people carry it on until 21 or 25 or whatever. So all those sorts of things are instances where you actually are transferring the cash to the kids. So it makes sense to just keep those in mind when we're looking at trust distributions, because that, again, will will sort of determine how much you can pay. And I hate to be a microphone hog, but just while I've got it, I will just quickly jump onto another question, which is very similar. This question is, I used to distribute from my trust to a company and benefit from the lower tax rate. Is this still available given the base tax rate companies and problems with loans from companies to trusts and companies to individuals? So that's, I think I know where this question's come from, and this person's obviously got some good understanding of the issues when you have a loan from a company to an individual. The answer, the reason I'm tying it in with the question on the adult beneficiaries is because it's the same issue for the ATO. They're concerned that people are having the benefit of cash and they've paid less tax than what they should have to have that benefit themselves. So the answer, can you make a distribution to a company and benefit from the lower tax rate? The answer is exactly the same as, can you do it to adult children and benefit from the lower tax rate? The answer is yes, so long as that cash is actually cash flowed and actually paid to the company. And just on the adult kids, I can hear people thinking, oh, can I just do a distribution to the kids and have them and actually cash flow it and have them pay it back to me? The answer is a hard no, because that's all part of the topics that the ATO have covered off under their practical compliance guidelines. They really have gone to town on this. They put a lot of effort in on their side to see what's available. So yeah, if we're looking to do it, you really need to just focus on what's actually being paid. And just on that company one as well, briefly, sorry, Dale, just 10 seconds. If you're in a situation where you've got a trading structure which has got lots of cash there and we're paying tax at the company rate, or even we've got a trust, sorry, that's got lots of cash and we want to lock in that company tax rate, it's also, in certain circumstances, there's the ability to do exactly as what's been suggested here, which is making the distribution to a company, actually transferring the cash to that company, and then using that company within your group to essentially be a bank account, which can then finance activities of other entities within the group. So the answer to that company one is yes, you can definitely do it. Yes, you can still, yes, you need to transfer the cash, but that's not a bad thing, because if you can set it up like a bank account, it can have some really good benefits for the rest of your structure anyway, and still keep that corporate tax rate in play rather than having to deal with silly high individual marginal rates of tax. Anyways, I'll stop now. Thank you. That's that question done. Back over to you, Dale.
Thanks, Chris. Before I move on to the next question, I can see quite a few faces, but it'd be great to see a few more faces on the screen. So if you've got a camera and comfortable turning it on, please do so. I'd love to see you. Thank you. So the next question is one from Lee. So for a sole trader, what can we claim in the way of furnishing an equipment for a home office, and also for travel, fuel, and accommodation to other places for meetings with clients? And do we need to keep a logbook? Great questions, Lee. So I'll start off with the home office side of things. There's really three ways that you can claim home office expenses. First one is actual costs, which is really painful, going through and trying to work out how much of your electricity is being used by the devices that you're using in your office versus the wattage that the rest of your household stuff's using. It gets really crazy. The second method is there's a 52 cents per hour rate that is intended to cover off on heating, electricity, and basic occupancy type costs. Now, if you're claiming that one, you do have the option of claiming depreciation on other specific equipment that you're using for work from home. Now, you have to be really, really careful. You've got all your receipts for this stuff, and you have to be really, really careful that it is things you're legitimately using for work purposes, and how much you're using it for work purposes versus private use. So if you happen to go out the back and set up on the nice table out in the sun because it's a cold winter day, and you want to claim the depreciation on your outdoor furnishings, you're probably not going to have much luck pushing that one through if the ATO audit you. It's probably going to end up leaving you pretty red-faced. So be pretty sensible about it with that sort of thing. Even think if you have a dedicated space you use for working from home, do you also use that space for non-work purposes, just managing your own personal finances and other things you get up to? That all affects your percentage on that sort of stuff. The third method of claiming home office costs is one that's been introduced since COVID, which is 80 cents an hour. Now, the negative of this one is that's pretty much all encompassing. It means you can't claim other things. So if you're claiming the 80 cents an hour, you can't claim things like phone, internet, electricity, gas, or depreciation on other stuff. That's all wrapped up in the 80 cents an hour rate. So it's safe in that as long as you can justify the hours you're claiming as being reasonable for what you work from home, then great, you don't need to keep receipts for everything and work them all out. But the downside is you may end up worse off on that rate than if you have a legitimate claim for other costs that you do use for work. So in terms of, there was a question you had, Lee, as well about claiming rent in the chat box. So that one, I have done that for clients in the past, but not for the whole rent. You have to be very, very careful about how much of the floor space is used for working from home versus for private domestic use. And it's not just square meterage, but also time you're using that space as well that comes into play. So it's possible to claim it, but I would say there's a degree of risk in claiming that if you do get pulled up by the ATO on it, they do tend to be very brutal on that sort of a claim, and you need to have a really, really good argument and be persuasive to make sure that it stands up. And things like evidence to support that are also really important. So if you've got good floor plans and square meterages mapped out, that you do have, that you can supply photos, schedules of how long you spend working in those areas and that type of thing. It's all evidence that helps you claim.
It sounds, can I just jump in, Dale? Sorry, it sounds quite rigorous. But the reality is it is rigorous, and they do that because they just don't want to open the door to everybody claiming their rent, as you can imagine. And they basically, the area needs to be used solely for that purpose. It can't be used for anything else. As soon as it's used for something else, they can knock the claim on the head in its entirety. So it's really an area which is specifically designated for that usage.
So we have another question that was submitted beforehand from David Reed, and I wouldn't say it's necessarily an end of year tax planning question, but I do think it is a good tax planning question. So the question is, if possible, it would be good for businesses to understand fringe benefits tax and how to manage, mitigate, and avoid this, as many companies do or would like to sponsor, attend events, facilitate luncheons with their clients, etc. Are there any legitimate strategies to minimize the exposure to FBT and the ATO? So don't get me started on FBT. I hate it. I think it's about one of the worst taxes out there, and one of the ones that has the most rigorous in terms of what you need to do to manage the circumstances from it. So really, it's the tax on providing goods, services, cash, or other non-tangible but monetary value benefits to employees and associates of a business. So it's primarily companies that have a challenge with FBTs, but it is relevant for trusts and other business structures as well. Now, the key thing there is it's employees and associates is the main risk area. So the other element of it that is a challenge is anything that looks or smells in any way like it might be entertaining is going to be a fringe benefit, and you need to think about it. So ways to mitigate that, I'm not going to go into heaps of detail here because we could do a whole other topic on it, but things to think about is in terms of entertaining, is it on your business premises, or is it out at a nice restaurant or a nice football stadium or something like that? If it's on your business premises, it's less likely to be subject to FBT, less likely you need to worry about it. If it's more in the nature of sustenance rather than gourmet food and alcohol, then you're more likely to get away from it. So if it's sandwiches in your business office, then that's probably fine, because we all need to eat. And if you've got a long event going on, then that's fine. But once you start introducing alcohol, is seen very much by the ATO as a form of entertainment. So that becomes problematic. In terms of things to do to mitigate that, there's another factor that comes into play for fringe benefits tax, which is known as minor and infrequent. If you're doing something as a one-off and the dollar value per person is not very high, if it's less than $300, then you can probably argue that it's not a fringe benefit. It still might be entertainment. Entertainment's not tax deductible. So that might mean you don't get a tax deduction for it, but you might be able to stay out of submitting a fringe benefits tax return for the business, which is a lot of red tape and rigmarole. So David, we can talk about that one offline with you in terms of specifics for your circumstances.
Yeah, thanks, Dale. I was going to take you out. That's all. That's why I was asking.
Well, we might be having sandwiches in the boardroom from the sound of my comments.
I appreciate it, though, mate.
Chris, would you like to look at another question?
Yeah. I've got Alice. I see your question in the chat there. I'll just jump on that if I may. Are you talking about the situation where you've got the work entity which is already paying for the internet and the phone and whatnot that you're using, and then you're saying, I'm going to use a nasty word, can I double dip and also claim those as my home office?
I was saying more with that 86 cents. So you know how that's sort of the flat rate that they say per hour. If you're getting subsidised already for certain things like your internet and your phone or what have you, can you still use that?
No, definitely wouldn't, because they'll yes, you can, but it is extremely high risk. It's not what they're trying to achieve. So yeah, no, I wouldn't be doing that. Yep.
You'd have to be to be able to claim it, you'd have to be actually getting paid a taxable allowance that you declare as income on your tax return, and then claim the cost as a deduction against that. But if they're purely reimbursing you and it's not something that shows up on the ATO pre-filling information, then that's what Chris said, you can't claim any more on that.
Awesome, thank you.
That's actually a really good point, Dale. Thanks for picking up on that, because in some instances I've seen in the past where people are paid an allowance for certain things, which goes on as their own taxable income. And really, as soon as people see that, they should be thinking, okay, well, I'm getting paid an allowance because I've got some expenses here. So you should be thinking, what can I claim against those expenses? Sorry, Dale, I overlooked that part, but you're bang on. If it shows there as an allowance that's taxable, then absolutely. If it's just a reimbursement, then it's not taxable to you. So yeah, good one. Thank you, Dale. Please do feel free to ask any questions in the chat. This is essentially your time to have any of your questions answered. We've got some others that have come through that I'll run on with, but feel free to jump on the chat and we'll try to answer any questions that people have. One which I will answer was this one may be a little bit specific, but a question's been asked: is it better to pay myself dividends from my company or salary and wages? So in this situation, we've got somebody that's obviously an employee of a company which is earning income, and they're getting paid as an employee of that company. And the question is, well, should I take myself off salary and wages and pay myself dividends from that company as opposed to salary and wages? And it's a good question, and I really like the way that this person's thinking, because I sound like a broken record, but in some instances, absolutely yes. In other instances, not so much. So I'll use an example of one of my clients, and I saw them in here earlier, but they've obviously had to go, which is good. So they won't know I'm talking about them because I won't use names anyway. But long story short, these guys have rather a mature business, has been operating in the industry for many years. They've paid lots of tax over the years. They have a bucket load of franking credits that have resulted from having paid that tax, and they have a bucket load of retained earnings that that the company's earned over time. In their instance, their personal tax situation was such that their personal tax rates are, yes, they are. They're in the 47% tax bracket themselves, not by a great deal, but enough. What they were doing was their company was in a situation where they don't pay payroll tax, so that wasn't a factor for it. But in this particular instance, we've gone, okay, well, understand there's some cash flow pressures for the company at this point in time. These guys are also looking to take a bit of a step back from the trading operations of the company and bring in the next generation. So they were still paying themselves a decent salary and wage from the company themselves. And on that salary and wage, there was also PAYG withholding, which needs to go to the ATO. So they're paying themselves the net salary and wages to themselves, and then ripping a chunk out of cash and giving it to the ATO as PAYG withholding. So taking a step back and looking at that whole situation, we've gone, okay, well, we need to get this net pay to you guys, because I understand you still need to buy bread and butter. So we still need a certain amount to live, which is fine. But let's do that by way of dividends. And instead of paying the PAYG withholding to the ATO, you've already got these franking credits that the company's paid over many, many years. So that those dividends that we're now paying you, instead of having to pay that PAYG withholding to the ATO, you can just get your franking credits back and declare the credit that way in your own name, rather than having to rip out additional cash out of your company year on year and pay it to the ATO. And in that particular instance, it saves that couple, I kid you not, $60,000 a year just by that one strategy for them. So that in that instance, it's a bit of a reminder in that just because something's always been done a particular way, and it may have been done a particular way for a very good reason at that time, it's still a good idea just to take a step back every now and then and just have a bit of a look at the bigger picture and just make sure that circumstances haven't changed over time, or see if there's anything else that we can do. Anyway, sorry, I'll stop talking again. Over to you, Dave.
So Jane's asked on that point, Chris, and I might answer this one for you. How do you determine how much dividends you can take that are fully franked? Do we have to ask our accountant, or is there in somewhere we can look in zero? So the amount of dividends you can pay out of a company is basically the amount of retained earnings that's showing on the balance sheet. It is always good to ask your accountant if you're looking to take out anything that's going to go anywhere near that total retained earnings figure, because if, for example, the scenario we talked about earlier where there's a loss in the current year, if that loss is a separate item on your balance sheet, then it's actually going to reduce the retained earnings amount, and you may end up having more that you've taken out than what your retained earnings are. In terms of what's the optimal amount to take out and what's the tax impact of the dividend, that probably isn't asked your accountant. One, because it involves looking at what your personal income situation is and what your average tax rate is versus the franking rate on those dividends, and that's a balancing act, and you get to a point and you'll end up having to pay some extra tax for the difference in tax rate. I'm going to address two last questions quickly before we wrap up, because I'm conscious we're getting close to time. And so the first one of these was another one that Alice had asked. Thank you, Alice. And I'll cover it fairly quickly. So in a company situation, if there are carry forward losses and you then sell the shares in the company and there is a turnaround and the company becomes profitable in the future, but in a separate industry, are you still able to take advantage of the losses? Okay, so there's a thing called, there's some issues with companies and changes of ownership that mean that losses can get quarantined or even lost. So the main thing there is if the ownership changes, you've got a problem. If the ownership changes, that company, to use those losses, it needs to generate income from activities in exactly the same industry. And that can be quite hard to achieve because there's an argument that if you're not doing exactly the same activity, are you going to still be generating losses doing that activity? So if you've tweaked things enough that you've changed it from loss making to profitable, then is that still the same activity? That's the argument the ATO would be making if you were in that situation and they were looking at it. The other one is if you change your business activity, if you've still got the same ownership of the company and you haven't done that ownership change, you can still claim losses from different business activities. So people sometimes do have losses in a company and they leave them open when they finish that activity and keep it alive in case they decide to take up another business activity. But as soon as you change any of the ownership of that company, you run into some challenges there. Thank you for that question, Alice. The last one we had was from Craig Shanley. So it's a very thought-provoking question. I'm not quite sure it's completely on topic, but I'm going to throw it out there anyway. So one very unpopular for some is the raising of the GST. I believe we have one of the lowest rates in the developing or developed world. And yes, it is 10%. GST is pretty low. Most other developed countries have a higher GST rate. I would say, yeah, it's not a politically popular topic to raise it because people know that it's going to hurt the end voters' hip pocket. I think if they were to look at raising the GST, there'd need to be a lot of talk around what the trade-off is. There's a lot of inefficient taxes out there, particularly state taxes like stamp duty and payroll tax that were talked about being made obsolete when the GST was introduced. And here we are 22 years later and they're still around and still painful. They're inefficient taxes. We actually would be better off, in my view, with a higher GST rate. If we didn't have some of those other taxes, it would actually simplify Australia's tax system by quite a bit. So interesting question, Craig. I'm not sure when it'll happen. I'm sure it will happen eventually, but it'll take some brave politicians for it to happen. I might start to wrap things up now, unless anyone has any last questions.
Before you do, Dale, I just saw one from Craig Thomas come through, so I might just jump on that quickly if I may. And Ben, your question is a very good question. I can answer that one offline. I feel you may already be aware of it, but I'm happy to chat offline on that one. So Craig, in answer to your question, this is actually a really challenging topic, which we're seeing a lot of at the moment in our client base as we're working through strategic tax planning at the minute. One of the challenges that people are having at the moment is people have taken advantage of the immediate write-off and the accelerated depreciation and everything like that for purchasing vehicles previously, and then they're selling them in current years. And of course, from a tax perspective, you've claimed the entire cost of that vehicle as a deduction in previous years. So now when you sell it, the entire sale amount is all taxable. Everything's taxable on that entire sale if you've fully claimed that vehicle in previously.
Except so 1/11th, that'll be GST, Chris.
That's exactly right. Yeah. So coming back to your question, Craig, 1/11th of the sale price, as far as the ATO is concerned, regardless of what it's being carried at on your books, if you sell a vehicle for 110,000, they want 1/11th of that for GST, assuming you're GST registered. They want 1/11th of the sale price as GST. If you accidentally forget to charge GST on it, the ATO don't care. They say, that's fine. That's a taxable supply that your business has made. You're registered for GST. You owe us 1/11th of what you've sold it for. So the answer to your question, Craig, is unfortunately you can't minimise the GST on it. GST is what it is. But an extra caveat is just be aware that if you have claimed the full depreciation previously, that entire amount will be taxable. Sorry, Dale, over to you.
That's okay. Yeah, I think that's probably a key point with all of the instant asset write-off stuff. It's really just bringing forward your depreciation claim. The government's not really giving us any extra deduction at the end of time. It's all just being brought forward. So it is something to watch for. So I might wrap up now, given we're pretty close to time. So thank you for attending today's Business Booster event. We hope that you've learned something that you can apply to your business. The winner of our $100 gift card for the most thought-provoking question that was submitted prior to the event goes to Lee Winter. Well done, Lee. Great question. So Kay will be flicking that across to you afterwards. So I'd like to thank Chris for co-presenting today, and I'd like to thank Kay, who's been quietly on the screen there, legs spinning like a duck underwater, making things happen for this event.
Keeping me on time.
Thank you both, reminding me about disclaimers. So our next Business Booster event will be on Thursday, the 18th of August. And the topic for that one will be, does your business need a board? So there'll be more information on that one coming out later. So on behalf of Chris and the rest of the Advivo team and I hope you enjoy the rest of your day, and thank you very much for joining us today.
Thanks very much, everybody. Much appreciated.
Thanks very much.
Cheers.
Thank you.